taxes don't go away in retirement. In fact, if you're not careful, they can take a bigger bite than you'd expect. And the saddest part, most of the tax mistakes I see retirees make are 100% avoidable if you just know what to look out for. Hi, I'm Caitlin Sester, co-founder of the Retirement Co. And over the years, I have sat with so many couples who are doing everything right, except when it comes to taxes. And that one piece ends up costing them tens of thousands of dollars they didn't plan to lose. That's why I'm making this video, because I don't want you to be one of them. So today, we're going to go through the 3 biggest tax mistakes I see retirees make in real life with real examples and how to avoid them. Mistake number 1. Pulling from the wrong account. One of the first mistakes retirees make is not having a strategy for which accounts they pull money from and when. A lot of people just think, well, I'll spend my IRA first since that's where most of my money is. Or I'll spend my cash and then tap my investments later. But the order matters, and it matters a lot. I had a client, we'll call her Janet. Janet was 67, divorced, and had about $900,000 saved across her IRA, a small brokerage account, and some savings. She didn't think much of it. She just started pulling from her IRA to cover her expenses. What she didn't realize was that those withdrawals were bumping her into a higher tax bracket. In 1 year alone, she paid over $8,000 more in taxes than she needed to. When we sat down together, I showed her what would happen if she pulled money from her brokerage account first, where gains were taxed differently, and paired it with a smaller IRA withdrawals. Not only did it lower her overall tax bill, but it also reduced how much of her Social Security was being taxed. This is why having a withdrawal strategy matters, because without one, you can end up giving away thousands of dollars unnecessarily. Another big mistake, not understanding how capital gains work. Here's the simple version. If you sell an investment you've held for less than a year, it's taxed at a higher short-term rate, basically like ordinary income. If you hold it for more than a year, it's taxed at a lower long-term rate. I had a client, Diane, who did not know this. She sold a big chunk of stock she held for 10 months, thinking, what's the difference? That one decision cost her an extra $6,000 in taxes. If she had waited 2 more months, it would have been taxed at a much lower rate. Now, I'm not saying you should never sell investments short term. Sometimes you need the money, but knowing the difference and timing things when you can make a huge impact. It's not just about investments. Capital gains also comes into play if you sell a second home or even land you've been holding. I had a widow sell her late husband's old property without realizing how much the gains would hit her. She told me later, Caitlin, I just wish someone would have explained this to me before I had signed those papers. And that is why we're having this conversation now, so you know before it's too late. Mistake number 3, missing deductions and opportunities. The third mistake is leaving money on the table by not using deductions and special opportunities retirees have. One of the most common is charitable giving. I had a client, Barbara, who gave thousands to her church every year. She would just write a check from her bank account. Sweetest woman out there. But here's the thing, she was also taking money from her IRA to cover her expenses and paying taxes on every dollar. I showed her how she could do what's called a qualified charitable distribution, which basically means giving directly from her IRA. That way the money never counted as income for her and it still went to the church where she wanted it to go. Just by changing how she wrote the check, she saved thousands of dollars and was able to give more joyfully. Another example, the standard deduction. A lot of retirees don't realize how generous it is, especially after 65. I had a couple who were still itemizing every little expense, mortgage interest, property taxes, medical bills. But when we added it up, they were way better off with the standard deduction. They'd been overcomplicating things for years. The bottom line, don't assume the way you've always done taxes is the best way in retirement. There are new opportunities available to you, and we can help you use them. So those are the 3 big mistakes I often see: pulling from the wrong accounts, ignoring capital gains, missing deductions, and giving opportunities. And here's what I want you to take away. Taxes in retirement don't have to be scary, but they do have to be intentional. The families that I work with that I have seen thrive in retirement aren't the ones who know every rule. They're the ones who asked questions, got advice, and stayed curious. Because every dollar you save in taxes is a dollar you can spend on your grandkids, on travel, on simply living with more freedom.